This lesson will explain what the key elements of financial management are and what business numbers every personal trainer should understand and track. We're also going to learn some key terms. The basic financial documents that track the flow of money within your company are the balance sheet, the income statement, and the cash flow statement. Most critical numbers live on those documents. The balance sheet is a document that lists your company's assets and liabilities, among other numbers, from the time that you started your business. Reviewing your balance sheet gives you a quick handle on the financial strength and capabilities of your business. The income statement is also known as the profit and loss statement, or P&L. This document lists your company's income, which is the revenues and sales, minus your company's expenses, and it shows you the profit or loss over a specific period of time. A cash flow statement helps you to stay on top of how much money came and went through the business for any period of time. This document is critical because it helps you understand why, even if your company appears to be turning a profit, you don't have much money in the bank. Let's look at some key profitability terms. Now, the term profits should be relatively self-explanatory. The rub is that there are several terms that represent the profitability of your business, and keeping them straight can be confusing. Here's a primer on understanding critical profit numbers. Gross margin. Now, gross margin, also called gross profit. This is how much money you have left after you've subtracted the direct costs from the selling price of your product or service. The formula is income minus direct costs equals the gross margin. Now, the higher your margin, the better, because you need to have enough money left in the bank to pay your indirect costs or overheads and still make money. If you don't, then you are likely not charging enough for your products or services. Then we've got net income, and it's also commonly referred to as net profit, net earnings, current earnings, or just the bottom line. The formula is revenue minus expenses equals net income. This number is critical in that it reveals how much money is left after accounting for business operations. If the number is negative, well, then your company is not profitable and has in effect produced a loss. We've also got to look at some key ratios. Now that you have a handle on these critical numbers and how to calculate them, you can then begin to use ratios to understand the health of your business. Ratios help you to understand how these numbers work together. For example, a company's current ratio tracks the relationship between assets and liabilities. Following ratios over time will help you to understand the momentum in your business. To keep tabs on these critical numbers and ratios, create a spreadsheet that draws 5 or 6 key numbers from your financial statements on a weekly basis, and this is going to help you monitor the health of your company. Also, we've got sales and revenue. Now, everyone tracks sales. The mistake most business owners make, however, is that they only compare contemporary numbers with those of past time periods. Now, comparing figures to what you want them to be in the future is a much better way to go. In other words, your objective should not be to see how far you've come in the past year, but it should be to track your progress against where you hope to be coming in the next year. Now, also we've got net profit. Now, profits fix just about everything. As long as you are charging more than it costs you for stuff, then you can ensure that you'll continue to grow your company soundly. If you don't have profits, then you're aboard a sinking boat. Another ratio is debt to equity. Now, if your business has debt, it belongs on your quick check sheet. The point is to know that your ratio should be, and whether you want to establish a budget to begin paring down your debt level.